When a homeowner engages an agent, they'll sign a 3 to 6 month listing agreement. And then after that, the agent no longer listing agreement, it's expired. And there was just record numbers in I shouldn't say record, but very high numbers in Q4, record for recent memory. And so, I think that's a lot of it's just people not getting the prices they want. And ultimately, if that keeps happening, the market will correct itself in some form or another. Hey, those people will drop their prices to sell at what they want, or they'll just hang on for a year or two and then hope that, hey, next year, things will be better. Hey everyone, Chris Lopez here, and welcome to our January 2025 Denver and Colorado Springs real estate market trends update. So we're going to go through what we're seeing in the market from a trends and analytical standpoint, and also just have some discussions around what we're seeing as investors and professionals on what we're seeing around town. So I got the usual crew with me: Troy with Nova Home Loans,
Chris,
Brandon with Key Renter, Jeff with Envision Advisors, and Jenny down south. Good afternoon, everyone.
Good afternoon.
Good afternoon.
Yeah, so awesome. Well, we got lots of fun stuff to talk about today. As usual, we will start with trends, and then we'll let the conversation go from there. So, Jenny, as usual, tell us what is happening down in Colorado Springs.
Yeah, so I thought the most interesting stat was that for median sales price, we're actually up 7% year over year, January to January. And that's a lot larger than I was expecting. I was kind of expecting it to kind of remain neutral. So that was interesting that we've come up 7% year over year. And that being said, sales are down 20% month over month, from 877 in December to 696 in January. So I think things are just kind of, everyone's in a stalemate is kind of how, I see it, and that no one really wants to budge on prices, and no one's really taking too much action on purchasing properties. So it's kind of just slow and steady down here.
So with that median sales price, is that for single family homes, or is that for single families and condos and townhomes?
It's for single family homes. Condos and townhomes is kind of, in terms of absolute numbers, is 111 in December of 2024, and 87 sales in January. So it's really not a large population.
But isn't the sales price, and this is the first time I've seen this chart for PPAR, I was more talking about the average sales price. So it looks like the single family home sales price were up 7% year over year, but condos and townhomes were down 5.5%.
Yeah, but
Okay.
much fewer in number. So more dramatic impact, based on those. But, I mentioned it in, I just recorded the 2025 Colorado Springs Guide. And I think the reason for condos and townhomes having a decrease in median sales price is because kind of that downward purchasing power pressure due to HOAs going up quite a bit due to insurance and taxes, and just general, maintenance costs are kind of exploding. And I think that has a lot of pressure on what people can afford. So that would be my guess on that.
Okay. And so, it's kind of similar trends we've talked about here in Denver, where single families are appreciating modestly, but condos have not. But I'm surprised. 7% appreciation for single family homes seems a lot higher than I was thinking.
Same.
Do you think some of that driven on new construction driving that price up? Have you seen more of that in the last year than the year prior, or you think it's just truly the same house is selling for 7% more a year later?
Yeah, it's interesting because if you look at the way PPAR does it, the new construction is included in the all homes, like the white section. And then if you go to the blue section, which takes out the new construction, it's still up almost 7%. So kind of a, very minimal impact to it.
And speaking on condos, I was kind of move up and just talk trends in Denver. We were just talking before this, Troy and Jeff. Hey, I think it was last month I mentioned that condo portfolio we're looking at, and there was not optimistic outlook. That investor decided to not sell right now, since it'd been anywhere from, a 10 to maybe a 40% haircut if he sold the whole portfolio. So he's going to just sit tight for a while. He may sell one or two if, hey, a couple of really good locations and you can just sell it and move it on. But they'll probably hold off for next year. But I know we were talking about a client who bought a condo and wanted to do a fourplex house hack, but is running into some issues, right, Troy?
Yeah, Jeff has some good details on that as well because he's been working directly with the investor on getting that sold. But yeah, it's just a tough situation. Jeff, throw some color
Yeah.
on that.
Yeah. So this this client bought a condo before finding Envision Advisors, and unfortunately, it was bought at the peak of when condo prices, August 2023. So that's when condos were still more or less still getting appreciation, and then what happened right after that? HOAs went up, insurances went up, and condo appreciation, and Chris has pulled it up, went down. And it's now he's basically at the spot where he has to just take a loss to move on. So he has to sell it, doesn't have a lot of equity, and most likely after paying all the fees and closing costs and realtor fees, it's going to be he's just going to have to take the loss, but it'll get him out of a pretty much bad investment because it wasn't going to cash flow anyways, and into something that will work for his goals. So lesson learned is make sure to find an investor-minded agent that can help you.
All right, moving on here to the Denver trends. You guys can see this on the screen here. So this is from the DMAR January report on here. So same thing. We're gonna look at the actually we'll do single family and then condos separately to kind of tell the tale of two different asset classes. So for single family detached homes, year over year, our prices are up about 5.6%. The median is up 2%. And then the attached, this is where it's interesting. The closed average year over year for attached condos is down negative 4.4%. The median is up about 0.8%. So again, telling a lot of the same story here where we're seeing single family homes appreciate and actually more than expecting year over year. We'll see how long that holds through the year, but condo prices are down as well. Now, another thing is inventory. I think it was right around the summer of last year we started seeing inventory pick up a lot. We were at 57% year over year inventory increase just in single family homes and condos. So while that sounds dramatic, that's kind of that same trend line we started seeing, I think, in like May or June of last year, where everything spiked year over year. But it's in that same typical range. Last month was about 6,900. This month about 7,600. The average is still in that like 12 to 15,000 range, so we're still below average. And this chart here shows a really good graph of the inventory here. So that green line is, combined single family and condos. And, we see that same seasonality trend. And right as it's spiking up here, this was, I think, in May of 2024 at the bottom of this green trough right here, maybe a little earlier than that in April. And the inventory just exploded, right? That's the highest it's been for at least about 10 years. And we're all wondering, hey, is that going to stay up there or is it going to start coming down? Well, as usual for seasonality, it looks like a cliff dropping off there from, November, December timeframe into January. And now the inventory is starting to increase a little bit, which is the typical thing we see of like the wave trough, or I don't know the best way to describe that visual on there. So you guys got any comments or any surprise by this trend?
No, not really. Not from my perspective.
Yeah, go ahead, Jeff.
How much is that, if we're being honest here, how much is that like this real inventory? Because how many of those people just list it thinking they can get COVID prices is like, oh, I bought it, 10 years ago in 2015. It's 2024 here. They listed, my neighbor sold his house for 800,000. My house is way nicer. I have a deck and this and that. And, I'll sell it if I have to get my price. And if I don't get my price, I'll just withdraw it from the market or just make it expired listing and just try again next year. So like I feel like some of that is like kind of unmotivated sellers where they're not going to give up their 3% mortgages from Troy to take a 7%. So they're kind of like, I'll sell it if I get my price to go from 3% to 7%, but I'm not going to lower the price. So I would like to see a little more in depth of like, okay, of those, what's like the average price drop? And we see the close to price to list ratio. That's kind of a cool percent. You can see that as well, 98.52. So that kind of shows it a little bit. So they are pricing a little aggressively and not getting 100% of list like they used to. So yeah, that's my comment on that. I feel like some of that's just not fake inventory, but kind of misleading, like unmotivated seller inventory.
Yeah, I mean that's still real inventory though, right? Because it's out there. But I agree with you. I think a lot of people are in that boat. I remember seeing some stat last year. It's not in this DMAR trends report, but at the end of November, December, it was like basically a record setting for recent memory of expired listings, withdrawal listings, and typically, when a homeowner engages an agent, they'll sign a 3 to 6 month listing agreement. And then after that, the agent no longer has a listing agreement, and it's expired. And there was just record numbers in I shouldn't say record, but very high numbers in Q4, record for recent memory. And so, yeah, I think that's a lot of it's just people not getting the prices they want. And ultimately, like, if that keeps happening, the market will correct itself in some form or another. Like, hey, those people will drop their prices to sell, at what they want, or they'll just hang on for a year or two and then hope that, hey, next year things will be better.
Yeah, I think it reflects that just the underlying thing of like, what's their story of what do they have to go do if they sell this house, right? And when the conditions are the way they are with rates and all that, like it's just not that attractive to go buy something else. So they're not like having to sell. So like Jeff said, it's just an unmotivated seller. Like they're kind of throwing it out there hoping, but unless they get that price, they're not going to like go end up with the same mortgage payment for less house. And so it's hard to motivate that guy to drop the price.
Yeah. And kind of on that note here, I'm looking at January 25 pending. So that's, properties under contract. So mark pending in the MLS, 3,061. In January 24, 3,063. So two properties difference. Wow. Close was very similar. January 25 was 2,259, so 2,259. And in January last year was 2,208. So pending and close looks steady. So, hey, demand, I would say steady, but then more listings came online, so inventory builds. So it looks like demand has stayed steady, not really increased or dropped off is how I'm reading that. And then talking on here, as we're talking about, the ups and downs of the inventory on here, this is seasonality, right? So this is a really important factor for everyone. Hey, if you're coming time to list a property, buy a property, you want seasonality. Hey, best time to buy for investors, Q4. Best time to sell, usually Q1, early Q2 to go out there and sell. But Jeff, we were talking about here before the importance of rentals for seasonality as well. And so same thing, if you're out there looking for a place to rent, Q4 is a great time to rent because that's where rents are softest. So talk about the rental seasonality trends. I'll have Jeff and then Brandon, I'll throw it over to you as well since you've got a lot of data on that.
Yeah, I can give data of my small sample size of 29 doors or mix of rent by room, Section 8, long-term tenants, and a sort of living house. So what I've found in the past is rent by, I'll just go through each category. So rent by room definitely has a big impact on seasonality, even though they usually have less belongings and personal property as the long-term tenant. They don't like to move in basically from October through February either. So when you have a vacancy pop up during that time, you just have to expect to get $50 to $150 less per month for that room. And that's another reason why you should do a shorter lease, because you're not locked in at the below market rent for more than 2 to 4 months anyways. You just want to fill that vacancy and get to the spring and summer if you have one pop up. The biggest killer of any property manager and correct me if I'm wrong, Brandon, a lot of landlords and owners, the thing that hurts them the most is vacancy. So whatever you can do to lower vacancy rates, and simple thing is just lower the rents, and maybe repost the ad, and sometimes you have to be a little more aggressive for it by room. And that's what I tell a lot of the clients I work with that do that strategy is don't just wait for someone to come to you. You have to almost be aggressive and go to them, direct message people that have a posting about them looking for a space. Just lower your price, be more aggressive, take better pictures, and you'll fill it. It's usually as simple as that. But try not to have vacancies in those 4 months, ideally. And then for long-term tenants, and Brandon, I know has way more data on this, but similar concepts is people don't want to move, whether it's a 1-bedroom or a 5-bedroom house. Families don't want to ideally move when the kids are in school. So when are kids out of school? That's also you got to think about. If you have a larger unit, you want to be around like when kids are during spring break, summer break time frame. That's more ideal when you have a larger unit available. And then the smaller units, just because they don't necessarily have a bunch of kids or family members, same thing. They ideally don't want to move when it's 12 degrees outside and snowing. They'd rather move when they know it's going to be 65 to 70 degrees and sunny. And then for just Section 8 tenants, I would say they follow the trends of long-term tenants. Usually they're more same thing. Families, they don't want to move when the kids are in middle school. The ones that are not families are just single people. Even though they don't have kids, school schedules, they also don't want to move when it's cold. And then again, you have to accept less rent. And then sober living, that's kind of outside the scope of this because that's a more unique demographic that doesn't have the same seasonality because it's not a normal tenant base.
Yeah, what'd you add on there, Brandon?
Yeah, I'm good overall. I think I would agree with all of that. I think one thing I'd add is like the type of single family home has a big impact. So if it's like really appeals to a family, it's in the suburbs in a good school district. We see those kind of properties like once you've hit like, okay, now people couldn't apply and get in before the school year starts, like the demand falls off a cliff and they just start sitting there. Whereas like, maybe in the older parts of town, where a lot of these properties appeal more to roommate groups and people moving out of luxury apartments in with one or two others. Now they can have pets, whatever. Those are insulated from that more. So we still see some seasonality overall, but just not as drastic. And I think I would say on our experience on like the condos and apartments is there is some seasonality in play there, but it also just really it is like a matter of what the current inventory is like for rentals. So some years we'll see that it's just you don't see a huge swing in seasonality. This year it was dramatic, and I think a lot of that had to do with a lot of new apartments coming online in like Q3, even some in Q4, and a lot of incentives in the market, and they're just a real trickle down there of and combined with like people ideally don't want to move, then there's some that are happy to move whenever and are looking that time of year, and typically that's reflected in less inventory, but when the inventory's up, it's just really tough.
So Troy, moving on to trends or financial trends, mortgage trends. A lot going on in the news with, the new administration coming online. Rates have been shot up, come down some. There's some talk about what Fannie and Freddie might be doing. What is going on in your world?
From my perspective, it's pretty much same old thing, and until they really start getting some traction with that, they won't react. Our companies won't react. I haven't seen much reaction of it from an origination standpoint. So I think we're pretty steady. We're still kind of hopeful with better rates, but we've been hoping for that for 2 years now, year and a half, ever since they were great and they went away from us. We've been rooting for that. So, yesterday wasn't really good with the data that came out with the inflationary numbers. Didn't help, but today's been a little bit better and recouped some of that. So, on a very short term, very finite standpoint. But from last month, I looked real quick from where we were. We're still a little bit better this month. So, hopefully we'll hold that for the spring buying season. and that'll make sense. I think people just have to get used to the new normal. I don't know what's going to drive these rates down anytime super quick.
Yeah.
I just don't see.
Like in
what's gonna
2023,
happen.
we had all the realtors saying, buy, like, marry the property, date the rate kind of thing.
Right, yeah.
Get your buy down, and it's only a matter of time. Has that chatter gone away, or do you still see a lot of people saying
It's kind of
that?
faded. I don't see.
The reality is setting in.
Yeah. Yeah. A good.
It gets
good
harder and
dose of
harder to
reality.
say that when.
Yeah, I mean,
not
I still have
coming
people talk a little bit about doing a 2-1 buy down, but I think you're really doing that product anticipating you're going to get a opportunity to revamp that before the buy down.
And you probably
runs
have
its
some of those
course.
expiring now from.
Yeah, I've got a
years ago, or-
few that are going to be staring at that, but they, we'll look at it and see if there's any improvement to be had, but most likely they're going to sit where they're at. So we see some stagnation there as far as refinances go, for sure. Mainly people are doing refinances or going to be doing cash out because of debt consolidation, things of that nature. And they have good equity.
Consolidating to pay off like credit card debt.
Yeah, that kind of thing.
So this was something I remember reading about years ago, and it was I don't know, theory might be the wrong word for it, but theory of, credit card debt's gone up a lot the last year or two.
For sure.
And then, credit card debt gets consolidated over to HELOCs and cash out refis. And so essentially people are, transferring their consumer debt into their primary residence debt. And the person's theory was, hey, that's going to start driving short sales and foreclosures.
Mm.
Do you have any thoughts or links to like, hey, that as that's consolidating, that's going to have like a ripple effect into like the real estate market then? Or is it, I'm curious what you're seeing from borrowers that you're working with.
Yeah, nothing
like
from
their
the
numbers and their equity positions.
Yeah, nothing from the borrowers I've been working with that I'm seeing. I could see where that theory could take hold at some point in time, but I don't think we're really seeing it still because the values are still holding pretty steady. It's all like we just saw in some of that data you guys were just running. The single family is slightly increasing. It's the condos and the townhomes that we were talking about, like with the client that we're working with, Jeff and I are working with, being in a little bit of a pinch because that condo value dropped off. But yeah, the debt and consolidation, and maybe it's just my clients. I haven't seen a lot of them coming back and say, hey, I need a huge chunk of cash out to revamp this. Usually what I've been seeing more lately is some of the clients coming back through and, hey, let's see what we can do to remove the mortgage insurance to improve the position on there.
But that's not a new loan. That's just dropping off,
that's
right?
just exactly. And that's petitioning your current servicer to say, hey, I've done this and that to the property. I've improved it. And the value's here now. And so I have a good crack at dropping off that mortgage insurance, which we've had some good success with over the course of several years, doing that where it doesn't make sense to revamp that rate, but you can eliminate the mortgage insurance. That's awesome.
What kind of LTV are you going to on when they are consolidating debt? On a
if you're doing cash out on a first mortgage, you're going to be limited on that. With a HELOC, you can do up to 90%.
Okay.
Generally, it depends on the bank and the credit union you might be talking to.
So you're at 80
but generally,
on first.
yeah, cash out first, you're going to be a little more limited on that. So a lot of people are going after those HELOCs, like you were talking about, Chris.
But they
'cause
still
those
at
are more-
90, it leaves some equity there, where it
A little
take
bit.
a good amount of movement for them to be doing a short sale a couple of
right.
years later.
And your banks and credit unions tend to be, I think, a little more conservative with their appraisals.
Okay.
So they're giving themselves a little more cushion and buffer there with that as well. But yeah, it's not getting rid of the debt. You're just rearranging it.
Yeah, well, I mean, it should be
cash
should be
flowing it.
cheaper than
Right.
hey, credit card debt's like in the 20s now, I think. Or
Yeah, it can be
it's
horrendous.
yeah, and at least cash out refund and primary is that in like the 7s right now?
Cash out refinance on a primary, yeah, probably low 7s.
Okay.
Yeah, pretty solid. Because cash out, from a lending standpoint, those are looked at as higher risk loans for sure. And so they price a little heavier than what they would as a primary owner occupied purchase transaction. So cash out refinances have inherent more risk from a lending standpoint.
So Brandon, when you were talking about the you're saying that realtor was saying a couple of years ago, the other saying, this is a lot more common in the commercial world, was survive till 25. You guys heard that saying, right?
Still brutal, and here we are in 25.
I don't think it's
What's the new one now?
I don't think there is a new one. I think it's the same thing. I think it's reality checking in.
Yeah.
I mean, because you come in now and I mean, rates have not dropped. And then now you're getting pinged with a lot of these buildings. Rents have, have softened up, like we saw rent declines a little bit, and
Insurance hammering people.
yeah.
I've been spending a lot of time in the commercial space trying to find an office for our company, and it's just the sentiment is as bad as it is anywhere there. I mean, everybody says just bring me an offer. Like they seem so desperate and they're trying to like communicate like, dude, the guy is hurting who owns this thing. Like, just there's nothing too low to at least throw it in front of them.
Have you made any offers or LOIs yet?
No, I think I have my first one going out today.
Could you share a high level for like how big it is and kind of like what their list price is and where you're coming in at?
So
without obviously getting into like detail,
totally.
Just high level.
So it's like 11,000 square foot, 3-story. Currently, most of it's rented. And so, they're listed at $2 million. I'm going to offer 1.4. So I don't know on this one if the seller will entertain that. I think they own it free and clear. So maybe not one who's like super motivated with, but I've seen other ones where like, what's that?
Surprised you offered 1.4.
No, yeah.
I thought you'd go to a mill.
Well, okay, and also
Jeff is saying insult him more.
that's with seller carry at like 5%.
So
okay.
100%, so all seller carry?
Well, like 80%.
Okay.
So pretty favorable terms.
So would you rent out just part of the office space?
Yep.
So you said 11,000 total.
And
How many
we
square
need
feet
like
would Kieran take?
300 or something.
Okay.
So we're taking like one floor of it.
So even if you guys aren't there high level, like it seems like those numbers would still be a pretty good investment.
Yeah, I wanted it to like, I spent a lot of time on rental comps in the area, and it seems like everybody in there is a little under market. So maybe there's a little room there, but you don't want to get real aggressive right now in this market. So,
right.
And I wanted to make sure it would cash flow with, while we're with an amortized loan. So, yeah.
Okay. How long does the seller carry for?
Yeah,
How many years?
That was my question.
They advertised it as they do it on a 25-year term at 5% for 5 years.
Okay,
Okay.
so 5 years on a 25-year AM.
Yeah, option to renew after that. Or they could call it due or renew at that point.
At the 5-year mark?
Yeah.
Okay. Huh.
So again, it's like, is 5 years far enough out to punt it to like, we'll figure it out then?
Right.
But who knows? Maybe commercial doesn't bounce back in that time and you're still looking at 8 or 9 or something.
I mean, if things go up to that, would the numbers still work for you? Have you run like worst case scenario?
Kinda, yeah. Because my alternative is I could go get SBA financing, but then I'm at like 9 or 9.25.
Yeah.
So that would be brutal there. But if in that time rents increased a little bit.
But SBA's come with a pretty big personal guarantee, right?
Yeah.
Yeah. And seller carry, I imagine there's no personal guarantee.
Yeah, I don't know. Is that usually it does? I mean, they're probably fine to take the property back, right?
Yeah.
They already know it and manage it, and so yeah, I think you're right on that.
Okay. That's one of the things because I've looked at SBAs in the past and talked to people, and that's like,
Oh, they want to like lien all your rental property.
Yeah,
and
like-
everything.
in your primary.
Yeah.
yeah, like
So
So
it's
it kind of
primary.
I've gotten an SBA loan for like business acquisition, and it handcuffed me to be able to do anything.
yeah.
Yeah.
What were you saying, Jeff?
We can talk on this. So all those adjustable rate mortgages coming due for people bought multifamilies, 20 to 100 unit buildings in 2020, 21, those guys are definitely going to be hurting and giving some opportunities to the multifamily space. So what I mean by that for you, Brandon, I think you should do 7 years or more, and you're going to do an arm on there just to give you more time, just in case, so you're not feeling the pressure in 5 years.
All right, I like it. I'll change my offer before it goes out today.
I've got a very different opinion on here. Are you sure you want to buy an office for your business?
No, I'm not sure. Yeah, I've been
That was the worst investment I've ever made.
really.
Yeah. Because I compromise business needs, I compromise investment needs. So they both are kind of like watered down. And of course, business plans change. It's like, oh, 4-letter word. Now I own this piece of real estate I don't want, and no one else wants it. I don't know. I don't know. As long as numbers work by itself, but like I am very like, I was in the same thing like that, the house hack type mindset for commercial property.
Yeah.
And I will never do that again. I'll make sure the building can stand on its own. Hey, if I don't, hey, like you, hey, I'm renting out 10% of the building. If I'm not there, it still makes sense. But like, I don't know, I got smacked on that
It
one.
certainly, it doesn't, I don't need to pay part of it is like we get a good rent as a company that's a little under market and it works at that, right? So, and I feel like we could rent that space to someone else at a similar rate, so it would stand alone. But yeah, it's a good thing to think about.
Yeah.
So going back to survive till 25, what you're saying, Jeff, that's where a lot of like, you know, the multifamily people and just commercial, you know, people are getting hit right now. We had talked, I think last time, and we talked at a conference this weekend that ICOR put on, Brandon, about the apartment supply coming on. Because last year, I think in Denver, there was like about 20,000 units delivered, 14 or 15,000 absorbed. And then that question comes up all the time in real estate investing. And you just got some data for like the kind of like the final wave. Can you share that?
Yeah, so this was an article that came out in the last couple of days in the Denver Business Journal. And so they were looking at they're interviewing Mark Williams, I think is his name, from the Apartment Association of Metro Denver. So he shared that, yeah, about 20,000 came on in 2024. The forecast looks like about 15,000 more in 2025. I thought we were kind of closer to this cliff of when this all dries up, but that's not super encouraging for me. And he said we're about 18 to 24 months out. He was it seemed like how he said that he was kind of guessing. Maybe it wasn't like looking at, or maybe there's more uncertainty when you go out that far. But just based on the absorption rate last year, I would have to think the absorption rate continues to fall, right? So we're not going to absorb another 15,000 units in 2025. So yeah, it just not a great outlook for multifamily and condos being rented in the next like 18 months. So
he was saying this would be like a 12 to 18 months for this final delivery.
He said 18 to 24 months is when we'll finally see the like cliff or nothing, because we will have a period where there's virtually nothing coming online, just because once rates spiked and the numbers quit making sense, there weren't any new developments.
Well, that
in
and
the
the
works.
Denver affordability stuff they passed in 22 also like had a lot of people hit the brakes.
So yeah, it's all these people though that got their deals far enough along they couldn't backtrack, I guess. So yeah, it's just maybe we're somewhere in 2026, halfway through 2026, when we finally see this really start to slow down significantly. But in the meantime, it's like it'll be a good time for renters who want apartments.
So it's a good time to buy.
Yeah,
like I think right around this time will kind of be the bottomish of the of like the bigger properties for like multifamilies. You know, again
you've shown that data where we saw single family homes continue to go up. And is it 1 to 4 unit, or where is it that's going way down? Or that's with this?
Yeah, line? 5+ units.
So 5+ really starts to plummet, like going back a year.
Yeah, because that's that's off being residential and commercial. Like, hey, I can go to Troy, I can get 30-year fixed on my 4-plex. And right now I have a 4-plex with 3.5% debt, right? And that's fixed until 2050 or something like that. You know, the apartments, the 5+ units, they don't get 30-year fixed debt.
Yeah.
At that rate.
No, I mean, they got the rate a couple years ago.
Does anybody do fixed rates on the commercial stuff at all, at any rate?
I don't think they fully amortize out, do they?
No, I mean, there's a couple
Maybe
things.
Give you 10 years or something.
Yeah, I've seen 10 years. I do know there are some very specific like HUD-style loans that will do like a long-term fix and a longer-term amortization. But that's like, you know, very, very few, and you're checking all the boxes to meet, you know, kind of meet affordability requirements for HUD.
So we've got a bunch, again, it's like what Jeff was alluding to. There's a bunch of people out there who have this stuff who are maybe they've already done, or maybe in the next couple of years they're going from 4 or 5, kind of their intro rate, and it'll adjust to 8 or 9 or something like that.
Yeah, I mean, I think, you know, we've seen pain. I think we'll see, you know, more pain. Hey, rents have softened. And I think that will, you know, kind of be the message throughout this year. And then we all know, you know, taxes, insurance went up. I do know I have seen quite a few people talk about this, and actually a few of those I'm invested in. They've had significant insurance drops, which is the first time I've seen insurance drop
Rates drop or they? Okay.
Insurance premiums drop. Yeah.
Okay.
Like one deal I'm investing, it's like a 270 unit building in Wheat Ridge. So huge multifamily. I own 0.00 some percent of it. But they shopped their insurance last year and they saved, I can't remember, it turned out to be hundreds of thousands of dollars a year in insurance and had a meaningful impact on NOI.
I would. Yeah.
But I don't know how that will play. That was before all the fires in California. So I don't know how that's going to play out, but it's going to be, I think the survive till 25 has been put in the ground. I don't know what the new mantra is.
Slayed. Yeah.
Maybe it's buy in 25 now might be the new mantra as these things come online. So speaking of insurance, I know Jenny, for your personal portfolio, you're making a strategic shift on your underwriting, insuring your portfolio.
Yeah, so I just kind of wanted to bring up like a discussion point, see what everyone's opinion is on this. But basically, Chris, I've had the opposite observation in terms of premiums and the direction that they're going. I've been getting some renewal notices and, gasping when I see them. So like to give you an example, I had a fourplex that I think it was about $4,500 in 2024, and then I got a renewal notice for $5,500 for 2025, which is kind of substantial. So kind of took a step back and kind of recalibrated how I'm looking at insurance. And I think for me personally, I think it makes more sense to kind of go more the self-insured route. Not saying I'm getting rid of insurance on the buildings, which I absolutely am keeping them, but I have decided to pivot towards increasing my deductible, meaning I plan on not making a claim, an insurance claim on any of our rental properties unless something catastrophic happens, knock on wood. Like I'm sure you guys have heard me talk about, I guess it was a couple years now, we had a $70,000, pipe burst on one of our properties. That to me is worthy of an insurance claim. A new roof, I'm just going to self-fund that. It has to be something major for me to even speak to my insurance provider, because I think, the fact that we did have that pipe burst, I think that is playing against us now because we have that, mark on our record, that sort of a thing. Even I know for my personal residence, that got brought up as kind of a mark on our record. So I think I would like for kind of, our record to kind of take a little bit of a chill pill, simmer. Hopefully nothing, catastrophic happens again like that, which, let's hope that it doesn't. But for the time being, I think I'm just going to increase all of our deductibles, make sure we have the cash reserves to pay, if we had to enact all of our higher deductibles now. So make sure you have that in your reserves. But definitely kind of taking that approach to reduce our insurance premium costs. So for full circle back to that fourplex I mentioned, in increasing our deductibles to, I think it was only $5,000, it reduced our premium back down to $3,800. So I don't know. That's my plan. I'm sticking to it. But curious to hear if anyone else has done something similar.
I have. I've been doing that for years. I can't remember when, but I've always, even before insurance rates went up, as you guys know, I keep healthy cash reserves. I'm a big proponent of that. That's, I think it's just prudent for any investor out there and any entrepreneur out there, keep very healthy cash reserves. And then, because I'm like, okay, the difference, I can save a couple $1,000s a year. The probability of insurance claim is pretty low. And I've always kept like a $5,000 to $10,000 insurance deductible on most of my policies, and I've been happy with it. And a big part of that was years ago. So I started getting into real estate investing about 15 years ago. One of my successful mentors and friends was like, hey, just a tip. Never claim a water damage unless it's catastrophic. If it's a small one, don't claim it. And for most insurances, don't do it. You're better off eating hey, if you eat a $5,000 expense, eat the $5,000 expense, because while you'll pay a little bit more there, over the long run in insurance premiums, you'll save so much money. So I've always kept that mindset of, let me eat things myself if they're small, right? Yeah, sub $10,000, right? Unless it's a catastrophic thing like Jenny's $70,000 pipe burst. Yeah, that's what you have insurance for, like catastrophic stuff, not for, routine, regular stuff. So I'm a big fan of that, and I've followed that, and I hope I'm not jinxing myself here because my insurance renew in a couple months, but I have not seen the big insurance increases in my personal stuff like everyone else the last couple of years, and I'm knocking on wood right now. And I don't know if that's part of the reason of, hey, no claims, and also have had a higher deductible. But I'm a big fan of that. I think do the math, but the math can make a lot of sense.
I agree. I've had some personal experience with, on the business side, I had a claim. I think they paid out. So I had a $5,000 deductible on this policy, made a claim. I think maybe we got to like 15,000 or something. This was related to a lawsuit, so that they were paying for the defense of that. And then the following year, my price went from about 8,000 to like 17,000 a year for the policy, and my deductible went from 5,000 to 25,000. So I'm like paying more than double for just a horrible policy that's not going to cover much. So that was lesson learned for me. I think it's the way to go, of like really, especially like with all of us, where you have a lot of insurance policies across all the different things you're involved with, and they don't all affect everything else, but there's enough where it's tied in, and they view that as, I don't know, there's probably an insurance person who could break this all down for us, but I've had things too where it like carried over and affected a premium on something else that felt unrelated to me. But yeah, I think it's a good way to go, of like plan on having the cash reserves and avoiding claims except for the catastrophic. And yeah, why not raise deductibles if that's what you're going to do anyway?
And there is that, I don't know the name of it, but there's that national insurance database where insurers, report their claims and all that. So, hey, if you have some on State Farm, Allstate or whoever knows about it. And,
you can't run
that's
and hide.
ripple effect.
Right.
And Jeff, I know we got a couple minutes here, then going to wrap up, but you were sharing a story about one of your house hacking clients, and they filed a claim. Can you kind of share the story and share some of the challenges you're facing now?
Yeah, so they filed a sewer line backup claim about a year and a half ago, so not that long ago, and now they're trying to buy their next property, closing next week actually. And because of that claim, they have to pay on this new premium for this house with a new roof, mind you, being put on this next upcoming week. They have to pay basically over $1,000 extra per month because of that claim they filed a year and a half ago for that sewer line backup. So, and I think that that costs about $20,000-$30,000. So you could argue, yeah, probably was worth it because it was water damage and it's hard to fix some of those things, and it was kind of catastrophic. It was in the basement unit, so. Yeah, we can see the power of sometimes it's better to have the reserves, be prepared to replace that roof yourself or handle a smaller type of, a bigger ticket item, but not file a claim for like 10 roofs, if there's a hailstorm come through. Like that, if there was a hailstorm that literally put, that blew over all the houses, then, for the stuff that happened in Erie and stuff like that, or what happened in Jenny, like that stuff is more truly, that's why what insurance should be used for, that, not just for filing a claim every time there's a hailstorm. And then you end up with your insurance raising the premiums on you or kicking you out of the insurance completely.
Well, another great session, guys. This was great to talk about. Some sobering topics as well, but great reminder to stay focused on the trends. If you have insurance out there, it's not great news anywhere. Just do what you can to mitigate it in terms of, keeping the prices where you can, and, mitigating, future increases by figuring, hey, when's the right time to claim or not. So appreciate Jenny, Jeff, Brandon, Troy, everyone coming out here. And of course, as always, if you guys have questions, comments, or want to reach out to us on here, let us know. Contact details on here. Troy's go-to for lending, Brandon's go-to for property management, and now medium-term rental management as well. Jeff for house hacking, room by room, and some small multifamily here in Denver. And Jenny down Springs for rentals and multifamily. So thank you, everyone, and we'll see you next month.
See you, Chris.
Bye.
Bye-bye.
Thanks.
Deal.